should I be investing in high dividend stocks as I get older? And that's a challenging question. And there's a couple of things to note about dividends. That dividends are not free money. That is, when a company pays a dividend, its value falls, and so should its share price. And study after study shows that's what happens in practice. So a dividend of itself does not create a higher return. What it can do, and this is particularly important in an Australian context where even through the GFC, the yields on if you had a diversified portfolio through the GFC, you were probably still getting a yield of 3% even in the worst years. So that avoids you having to sell much of your capital. And then the other advantage from an Australian perspective is franking credits. So when a company earns a profit and pays tax on it, to avoid that being double taxed, the Australian government gives you a credit for the tax the company's paid called a franking credit. And these franking credits have zero value in the hands of that company. They only have value when they're paid out. Companies that have big stashes of accumulated franking credits have an asset that doesn't show up very clearly on the balance sheet, but is of huge value to resident shareholders, especially low tax rate paying Australian residents like super funds and retirees. So paying that out creates value in the hands of the shareholder because it now liberates the 30 cents paid in taxes historically. On its own, it doesn't tell you very much. In fact, some of the highest yielding stocks are the biggest dogs because as a company's share price falls, the yield, which is calculated based largely on the last year's dividend, starts to look better and better. It tells you very little about what next year's dividend is going to be. So be very careful about using dividend yield as your sole means of selecting a company. It's really a flag to start looking.